As some of you know, and you can see this on our website, the Volatility and Risk Institute really launched last year, 6 months ago, and it's built on the legacy of what Rob started with the Volatility Institute back in the aftermath of the financial crisis. And the point then was to look at risk of a variety of types, primarily financial risk, however, through the lens of financial volatility. But in recent years, other risks have become more prominent, notably cyber, geopolitical, and of course, climate risk. And in starting to look at those, we realized a couple of things. One was we needed a broader, more interdisciplinary approach to the way that we were pursuing the analysis and measurement of these risks. And so we decided to engage in a cross-NYU, cross-university effort, people from other disciplines, and we've done that with a faculty advisory board that now numbers about 33 from across all of our schools and faculties. And the second thing we realized was that these risks were really in many ways interrelated, and spillovers from one could create risks in other areas. And our goal in looking at these was to recognize those two things, and also to try to think about ways that people in markets, people in business could develop ways to insure against some of these risks, to hedge against them, or if they're managing portfolios, whether they're business portfolios or asset portfolios, to try to construct those portfolios in a way that created resilience in the face of these risks. So that's really our goal. And of course, in the past 3 months or so, really, or 2 months or so, we've turned our focus from the cyber, the geopolitical, the climate, and the financial risks, which of course remain the pillars of what our work is, to the pandemic risk. And in fact, last evening, we had a meeting of our advisory board, and we all decided that we wanted to add that as a fifth pillar of risk, because this isn't going away anytime soon. It's going to be with us in breadth, depth, and consequence. It's probably every bit as significant, if not more so, than the great financial crisis was and still is to some extent, and it represents really a watershed in many ways in our lifetimes. Today, however, we want to look at cybersecurity. So why do we want to do that in the face of all these important and consequential developments resulting from the pandemic? And I think the reason is that, as I said earlier, we recognize that all these risks interact, and that people are still worried about cyber risks and what to do about them. If anything, today, it's possible that these interactions become thrown into more sharp relief than even before. We're going to be asking ourselves lots of questions about all these things. As we try to get the economy back to normal, what does that look like? What is the new normal going to look like? What are the legacies? And what are the lessons to be learned from looking at all these risks? So today, we have a conference in which it's somewhat more abbreviated than what we initially planned on. But nonetheless, we're going to go from now until about 1 o'clock. We will have a talk this morning. First, Rob, and to some extent, I will talk about what's new in the VRI and in VLab. We will then go to a fireside chat on cyber risk measurement with Phil Venables and Jack Freund. We'll take a break of 15 minutes. And then we will have 2 panels punctuated by a break between them. The first will deal with practitioner approaches to cyber resilience and how companies are thinking about that. And the second will look at cyber insurance. What does the cyber insurance market look like? Is it effective? How are buyers of insurance and sellers, writers of insurance thinking about these products, and how is that working? So thanks for participating, and I encourage you to look at our website. We will continue to share our work on all these things with you, I'm going to turn it over to Rob so that he can talk about what's new in VLAB and the VRI. Go ahead, Rob.
Great. Well, thank you, Dick. It's a new way to run a conference, and we're excited to see if we can say some things that are interesting for you to see and let you know what we're doing. One of the things about the COVID is that we have a lot of time, and this, if you can see my screen now, I assume you can. This is sort of my view of social distancing. We're headed to the Maine woods with our canoe, and we're ready to get along. But the idea is that we have a lot of time, and we're doing our research, and we're trying to figure out what we can say about what's going on. So we have some new things to talk about in VLAB. So let's get on with that. As probably many of you know, VLAB is our website of the Volatility and Risk Institute, and it presents risks on various financial measures and updates these daily. And we think of this as a public good to help people better manage their risks and understand what's going on around them. And well, we're all in the process of trying to figure that out today. The website is vlab.stern.nyu.edu, and so I encourage you to take a look at it. And when you do, you'll see there are really seven sub-analyses in there. There's models of volatility, correlation, systemic risk, long-run value at risk, liquidity analysis, fixed income, and climate risk. So today, we're going to first discuss a new section of VLAB, which is our COVID-19 case study page. And you'll find when you first arrive that there's a link to it right at the top of the page. We'll probably introduce it as one of the 8 measures pretty soon. So what are we looking at? We're looking at these amazing changes in the financial market that we've seen over the last 2 months. And what are the causes? Well, at least one set of causes are the infections from the virus. And what we'd like to know is, how can we understand the way the markets are responding to these kinds of infection rates? So next page. So when you get to the VLAB, you'll see the volatility map of the world, which is green when volatility in countries where volatility is low and red where it's high. And in January, it was pretty much green. And today it's almost everywhere red. So there is a lot that's happened, and we want to take a look at that. Next. What the new page does in the Corona COVID-19 page is it marries the volatility measures we have country by country with the incidence and mortality due to the COVID virus country by country. And in fact, within the US, it's state by state. And this is updated daily so that we can see how these things evolve. And one of the things that I possibly can show you, but when I tried it earlier, it didn't work. Let me just give one more try here. I guess it's not going to work. So if you go to this website, you can see up here it says April 21st. I guess this is when I took the screenshot. If you go click double left, it'll take you back to the beginning, which is in late January. And then you can go day by day through the process of seeing the volatility go up and the cases go up. And you can do this for the world as a whole. You can do it for, North Asia. You can do it for South America, North America, and so forth. And it's fascinating because we sort of forget exactly what the time pattern of all this was. And in fact, in many cases, there were very few cases of coronavirus in a country when, in fact, its volatility suddenly jumped up. And so we're interested in what's the process of this. Okay, next slide. So a simple summary that you can find on this website is to look at the blue curve on here, which is the total new cases. That's the difference between confirmed cases and people who have recovered or died from the virus. So these are new cases, and it's kind of the innovation in a way to that the markets might be looking at. And if you look at it starting in the beginning in late January, you can see new cases, it's a very small number, and then it starts to rise in March and becomes really quite high. And now the number of new cases is actually somewhat declining. It's certainly plateaued, but looks like it's, from a global point of view, it's slightly declining. Well, what has the stock market done during the same time? The red curve is the VIX. And you see that the Volatility Institute was somewhat elevated up here in February, but not too much. And then it started to rise dramatically, and it hit its peak right here when the acceleration of the new cases was most dramatic. That is, it's really the curvature of this curve that seems to be driving the volatility of the market. And then when it starts curving the other way, volatility is falling. So you could think of it as acceleration or curvature. And so it's interesting how how forward-looking the market is on this in this kind of plot. Next slide. So we've actually done a little model of this to take this feature, and it features the curvature of the new cases as a key variable. It also looks at some things like stringency and spillovers from global infections. I'm just going to show you a tiny piece of it. Here's a set of panel regression models from February 3rd to April 17th. And it's got about 80 countries in it. And what you see, these are the variables. And if you just look, for example, at the first column, you can see the number of cases is significant in explaining how much volatility has gone up. But the curvature in this country, in each country, is also significant in explaining how much the volatility of the market has gone up. In addition, there are global effects. And in this column, we use the USA. So you see the curvature in the USA is also a very significant explanatory variable for volatility in each country. It turns out it's also true if you use curvature globally. And if you put in time fixed effects as well as the country fixed effects, you see the country specific curvature and cases are still actually very important. So this is the kind of a model we're doing. This is estimated almost up through the present. We're trying to improve this and make it useful. But the idea is that it's a pretty quantitative way of trying to assess how the market is responding to this pandemic. Next, please. So let's turn to some of the other features that are new in VLab. So the most dramatic thing in VLab, of course, is just that the data is really different from what we've seen before. Here are plots of the volatility of the S&P 500 in red and the WTI oil index in blue. And both of those spiked up dramatically in the middle of March and reached levels of volatility that exceed what we saw during the financial crisis and are kind of like near the highest we saw in the 30s in the Great Depression. So this is a big event we're in the middle of. Next. When we look at correlations, there are a lot of correlations to look at. And in fact, we have now introduced a new statistical procedure, which is called a nonlinear shrinkage estimator, and it's designed for extremely large dynamic correlation matrices. We've published papers on this using up to 1,000 assets. And this is now built into VLAB, although we haven't got such big matrices going yet, but we intend to. But in doing this, we had to improve the way we look at correlations. So there's a new display, which includes, first of all, a two-dimensional view of correlations, which is based on multidimensional scaling, measures of correlations of one asset with all others, and the average of all pairs. And one of the things we see, and I'll show you this picture in a second, we see that equity correlations between countries are very high, but they're actually rising. Commodity correlations are not so high, but they're also rising as the volatility of the oil market goes up. Exchange rate correlations, interestingly, are not rising. They seem to be falling. Some currencies are becoming safe havens while others are not. So both sovereign debt and currencies are having falling correlations. And US asset classes, that is, the correlation across stocks, bonds, commodities, gold, real estate, and so forth, those correlations are also rising. So the volatility is going up with the market. So here's the kind of picture you can see. The left picture is the multidimensional scaling, and all the assets from this model are shown in 2 dimensions here, where the distance between them is a measure of how of the correlation. And so if they're close together, we say they're highly correlated. It means they're highly correlated. On the right-hand side, each box is the correlation between one asset and all the rest of them, and they're sorted by size from the highest to the lowest. And the solid line here is the average of these. So this is actually the average of all bivariate correlations. And as you can see, it's been rising over time a little bit and dramatically more recently. In fact, if you look at the bottom, you'll see a long history of exactly the same figure. And you can see this rise in the current. But in fact, you can also see that it was high in other times in our past. But it was not quite as high as this during the financial crisis. Here's the same picture for correlation between US asset classes. And you can see that they're not so highly correlated. In fact, one of the asset classes is volatility. So that obviously is, it has a rather different behavior. But anyway, the correlations are low, but they're really rising dramatically. Next. Here's the same kind of picture for commodities. And you can see the correlation between commodities has gone up. They're a little more spread out in this multidimensional scaling picture, but it's a pretty uniform display. It's not like the equities where they're really clustered together. Next. And here's the exchange rate picture. And you can see we've had a decline in the correlation between exchange rates over the last period. It may be having a little rebound right at the end here. But again, when you see this has actually gone up and down to some extent over a historical period. So there's a lot of information there to take a look at. So the next section of VLAB I want to show you is just what we're seeing in the systemic risk section. We have a measure of the undercapitalization of a single bank, that is how much capital it would need to raise if we have a downturn in the global equity markets like we saw during the financial crisis. And if you think of this as a bailout number, you can add it up for all the financial institutions in a country or in the world. And this is what it looks like for the US. And what you see in the US is in red, the improvement from, well, it was higher during the financial crisis, and it's been sort of falling as we've strengthened the financial sector. It actually reached a best case in 2018 rose to some extent after that as the economy slowed, interest rates, and the trade war kind of impacted the economy. But at the end here, it's shot up and is important indicator of the health of the financial sector. It's an indicator that I think is the policymakers are well aware of, and they're pumping money into the banks. They've reduced the regulatory pressure on them so they don't feel so constrained. And the banks are actually operating as part of the solution rather than the problem, I think, in this pandemic. In the background is what we think of as the capacity of the US to withstand SRISK without having another financial crisis. And you can see we've had a lot of excess capacity. It's getting a little closer now. Okay, next. When you look at the world as a whole, you see actually you add up all the countries in the world and you get a measure which peaks today at a number bigger than we saw during the financial crisis or the sovereign debt crisis along the way. Now, you should realize that about $1 trillion of this is China. And if you think that China is not likely to precipitate a financial crisis, then that could be part of the good news. I think we're also seeing a lot of willingness by policymakers to support the banking sector and to use it as a way of distributing much needed loans to the non-financial sector. So I'm not particularly concerned about this, but it's an important measure that we need to keep an eye on. So next. And this is just kind of what I said. So let's skip that. So I want to say a little bit about geopolitical risk. This is one of the 4 pillars that the VRI is looking at. And we have now a metric that is one of the features we want to talk about with geopolitical risk. And this is a measure which we call GEOVOL. And what it is it's a volatility factor which explains or measures how the volatilities of a broad set, maybe even all financial assets, go up at the same time. In other words, GEOVOL is a way of measuring how coordinated the volatilities are across asset classes and across countries. And these events that drive the volatility of everything at the same time may be political events, they might be economic events or military events, but actually now we think we are seeing health-related events from the COVID. And we're going to be putting a presentation up in VLab to show this, but let me just give you a preview of what it's going to look like, or not what it's going to look like, but what the results are. So in this table, we've sorted the GEOVOL events from the most important day of the last 3 decades, from the mid-90s up until I think the 17th of April. The most important event we think at this moment is the Brexit vote. But the second most important event, and you can see that the GEOVOL number is very close, took place on March 9th of this year. And it's the day when all of Italy was locked down and when the oil price war between Saudi Arabia and Russia broke out. So it's not totally clear whether this is a COVID or an oil price event, but having these both on the same day makes it an extraordinarily important event, and maybe the second most influential day we've seen over the last generation. If you look down the list, you see a lot of other events that are important. You see the China trade war, you see 9/11, you see the Chinese stock market crash, you see the Trump election, you see a lot of events, and you see that there are actually 4 COVID type events in the top 20 days that we've seen. So we're analyzing an important event, a set of events today. Next. This reflects the fact, this table reflects how much this GEOVOL impacts each of the countries that we've looked at. And it does not have an equal impact on all countries. So this has portfolio implications that we are interested in developing. Next. So the final thing I want to say a little bit about is climate risk. We've got a lot of research going on in climate risk. What we're trying to do is help investors figure out how to manage their portfolios in the face of these major events, which are potentially far in the future. It's actually not so far in the future anymore. And in fact, one of the interesting questions that we keep wrestling with is whether things like this pandemic may become more frequent if we have a lot of global warming and migration of animals and so forth and changing habitats. So there may be definite links between the pandemic and climate risk. So at the moment, we have been talking about showing return, Sharpe ratio, 3-factor alphas and so forth for something like 100 publicly traded green funds. We've updated our measures to use, instead of using the Fama French version of these factors, we use ETFs that are traded so that we don't have a delay in the data display, and so that we're quite clear that we're using investable factors. These are factors that you can take long, short positions in. So it's nice to look at the performance relative to these kinds of factors rather than the more academic Fama French factors. We have a series of measures of when there is news that the climate is deteriorating. When there's news that there's climate deteriorating, you might expect that the climate hedge funds would actually outperform the rest of the market. And we think that's a measure that's useful to look at. So we are doing textual analysis of the New York Times over the last 20 years. And we use daily estimates of what this measure is to try to figure out whether some of these funds are moving more or less with the climate news. We're not completely happy with our measures so far. So while we're doing this measurement on a daily basis, it's not part of our display yet till we're more comfortable with it. But let me just show you what you can see so far, the next page. So here's a sorting of funds based on our two measures. One is a measure of cosine similarity between the word counts in the New York Times and environmental dictionaries. And the second is a simple count of how many articles are classified as climate change or global warming articles. And these correlations are not very high. It's one of the things that's concerning us, but of course, we don't really know whether the market responds very fast to climate change news like this. So we're trying to find other ways and metrics to improve our reliability of this kind of measure. But in any case, this is a way of trying to assess whether the market really responds in the way we expect it to these publicly traded funds. And as a byproduct, we're hoping to come up with our own measures of funds which are actually particularly sensitive to these kinds of news series. and these will be included on this website as well. So that's what I want to say about VLAB. Please come take a look at it. It's a way of trying to understand the risks that we're facing, the future, and what's down the road, and we're going to be updating every day. So there's a lot of good information. So thank you.
Thank you, Rob. And I think we have time, maybe about 10 minutes for some Q&A. You can either raise your hand and we'll try to flag you. Matt Hempel and Matt Matisic will try to identify people who want to ask questions, or you can use the Q&A box and try to ask a question in that way. But either way, we'll try to answer your questions. I have one actually where somebody asked if we could make available the GEOVOL page that Rob showed on his slides. And I think the answer is most certainly yes. We're going to try to make those things available in a way that they are useful to you in managing risk. I don't know if Rob, you want to add anything to that.
No, that's right. We're updating this on a regular basis. We've actually gone back and done it every month for the last decade or so to see kind of what the events are, and we're pretty comfortable with what it's showing. We we're just doing the coding now to implement it as another page in VLAB, and at that point it will be readily available, and you'll be able to look at it every day. In the meantime, you're welcome to look at these slides. This is our most recent estimate. I don't know whether the question is whether you can have the historical or not, but anyway, this is what our current best estimate is.
Yeah, I think they asked, can the GEOVOL events page, which you showed with Brexit as #1, be made available? And the answer is yes. And of course, that gets updated with new information.
Right.
So the next question is just to everybody, can we share the slides? And the answer is yes, we're going to share them on our site to all of you.
They'll be on the website, and there will be a link to them. I guess we can put a link in on the web page too, on the COVID page probably.
Yep. Next question is any work related to machine learning? In other words, are we using new tools, artificial intelligence tools, machine learning, natural language processing to try to suss out what's going on in markets and how they relate to these events?
We are using some of these kinds of tools in the climate section, where we're trying to refine our measures of when there is news about the climate, and we're hoping to be able to clarify that measure so that we can talk about not only whether there is news, but is it good news or bad news? Is it regulatory news, so it's measure of transition risk, or is it physical damage news? Ultimately, we're going to use these kinds of techniques to come up with factor mimicking portfolios for these news events, and some of that is using the technology that's been popular in machine learning, and it also uses this big covariance matrix to improve the signal to noise ratio of these factors. So we have a lot of things going on that it's important to be statistically strong about these, because the signal is actually pretty weak that we're trying to detect in trying to find good climate hedge portfolios.
So maybe I'll take the next one. There's a dialogue on the Q&A going on SRISK. Basically, does the SRISK capacity figure, which shows a dip below where SRISK currently is, does that indicate something for capital planning, a greater need for capital buffers across institutions on a global basis or on a regional basis? The answer is, and Viral's already chimed in with the answer to this, I think the answer is definitely yes. Thanks for all. As he points out, Neil Kashkari, who's president of the Federal Reserve Bank of Minneapolis, has recommended another $200 billion in private fundraising by banks through equity issues. They certainly have the capacity to do that. And what we've seen over the past 2 or 3 years is a rollback of some regulations and a reduction, not just on a temporary, but on a more permanent basis in some of their the things that contribute to their resilience, including various capital measures. So we would recommend that as a regulatory prescription based on what we're seeing in SRISK. SRISK, I would just add, is a complement to other measures like stress tests. But if you take the two things together, and if we were to do a stress test that really reflected some of the things that are going on in the world, instead of, what the Fed's CCAR scenarios look like, then we would probably see that there is a need for more capital. Let's see if there's some more questions. Could the GEOVOL estimation be useful to forecast how COVID-19 risk will propagate across the world?
Well, I think one of the things you see when you look at the data is that it has propagated all over the world, and that's why it shows up so strongly in the GEOVOL measure. It has propagated, and the information that the financial markets respond to is much more, apparently much more than just the information in their own infection rate. And, I think some of the policymakers have been discussing whether they were clever enough to look at what was going on in Italy and China and so forth along the way. But in fact, I think the stock market was. And so I think that's why it's such a global event. And we're not really forecasting so much that it's a global event. We're observing that it's a global event. And we're actually, one of the things we can see is that there's an elevated risk of these kinds of global events at some times in history, and this is one of them.
And Viral also has chimed in on this too, and just want to make clear his response with which I agree, namely, the emerging market economies are really being hit hard by this. They are ravaged by war in many cases. They have weak healthcare systems. They have weak financial structures, and they are heavily indebted. And so you can look at this as a measure on a geographic basis of how vulnerable these countries are, and it helps you understand why the G20 is calling for a standstill in debt and moratoria for some of these countries. And I think that's a hugely important issue. And then Larry White asks, it appears that there are some geographic areas that will benefit from climate change, maybe Canada. If that's correct, wouldn't investments in, say, Canadian real estate be a potential hedge? I don't know if, Rob, you want to take that one on, but go ahead.
Well, I think so. If coastal real estate is going down in value, then what's going up in value? Where are the vacation spots going to be if they're not along the coast? Maybe they're along the lakes and stuff like that. Anyway, sure. I think that there are hedges for climate change. What we're trying to figure out is whether the market is actually pricing these things. And our assumption is that the market is pricing. So Canadian real estate's probably just a little more expensive than it used to be, I guess. So if you think of it as a hedge, then you buy the Canadian real estate and you wait, and if the climate gets worse than we think, then it will have been a good bargain. And that's exactly the sort of effect we're trying to do.
Related to that question, is the number of cases a factor when deciding if a company is a safe haven in today's times? If not, maybe company and country. If not, how do you decide if a country is a safe haven for investors?
Well, we're asking what the market's view on this is. If you look, for example, at what's happened to sovereign interest rates, you see when this crisis has come up, interest rates, or let's do it the other way, bond prices have gone up in the US, they've gone up in Germany, I think they've gone up in Switzerland, because these are viewed as safe havens. They've gone down in Portugal and Italy and a lot of other countries, especially emerging market countries, I think. And I don't have exactly the numbers here, but what makes a country a safe haven in this view is that the market takes it to be a safe haven. And it's not that it's necessarily safer, but the market analysts are viewing it as safer.
So other questions for the GEOVOL events? How long do you track? How do you track how long events have been at the top of the list? And then related to the sort of bigger picture, is your team collaborating with other programs like the Strategic Studies Division at Johns Hopkins that is taking a holistic approach to understanding the impact of COVID? And do you have a DoD liaison to provide your information to, or are they just directed to your VLab portal?
Well, we use the Johns Hopkins data. That is our primary source of data for the infection and morbidity data. We have not actually collaborated with them. If there's a suggestion from the audience, we'd be happy to. And the day-to-day stuff, we do think the day-to-day measures are going to VLab, but we have lots of ways of collaborating beyond that. We can share data. We have lots of capabilities for that.
So what about the market as a contrary indicator? If an investment becomes a safe haven, just because the market sees it that way, how really safe is it?
Yeah,
that's an interesting question.
I think that's right. I think the market thinks some safe havens are safe until they're not.
Right.
And then all of a sudden you see this dramatic flow of capital and change in prices, I think, as people would lose it. And I think that's obviously one of the questions about how much debt can a country hold. I mean, countries become safe havens, and then if they end up not managing their finances well, they may lose safe haven status, and it's pretty hard to get it back, I think, if you lose it like that.
In the analysis, how much weight do you ascribe to measures like vol, or skew? How do you incorporate those things into the analysis?
We haven't in this case. We do have measures of vol, and we very little. We have measures of volatility indices, but we don't really follow implied vols, because that's there are a lot of issues in how you do that, but you don't have nearly the coverage that we have by building statistical volatility models for all the assets and asset classes that are out there. So we would, but if we were doing that, we would have more information on skew and vol from the implieds as well.
That's from one of our faculty members, so we're going to recruit him to work on that problem. Viral also points out sort of the antithesis of a safe haven, and mentions that when Italian bond markets were hit by the statement from the new president of the ECB, they declined dramatically in value, and then they reversed, and Italy became a little more part of the Eurozone. But that's a huge question for the Eurozone. Are they really going to all support each other? And if they don't, what does that mean for the project and the future of the Eurozone in Europe? And I don't think we quite have the answer to that question yet.
And I think actually VRI has a very influential paper which talks about, are there limits to what the sovereign can do? And actually it turns out in the financial crisis, when the sovereigns in Ireland in particular bailed out the financial sector went up in value and the government bonds went down in value. So it's not so clear that governments have unlimited abilities to rescue the real economy.
All right, well, we're going to move on. This is great. A lot more discussions, and we welcome more questions and discussion about this in the future.